Long-term care is one of the biggest unknowns in retirement. You might never need it, or you might need years of a really expensive care that could cost more than your home. The challenge is simple. Nobody knows in advance, and that uncertainty leads to the big question we're answering today. Do you actually need long-term care insurance, or can you simply self-fund the risk with a larger portfolio? The answer isn't the same for everyone. It depends on your wealth, your health, your risk tolerance, and what role you want insurance to play within your financial plan. Today, we're going to break down the pros and cons of traditional long-term care insurance, a hybrid policy, and the self-funding approach. And I'll show you how to think about reserve buckets for long-term care so your retirement plan can handle whatever the future holds. And be sure to stay until the end where we go over a brief case study that illustrates how long-term care could apply to your plan. But before we dive into all that, my name is Ryan Noel. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. Let's talk about the uncomfortable math behind why long-term care matters. Long-term care isn't medical care. It's help with activities of daily living, bathing, dressing, eating, mobility, using the restroom, things like that. Medicare doesn't cover custodial care, and Medicaid only steps in after your assets are nearly gone, and the standard of Medicaid long-term care is depressingly low. So here's the 2026 cost reality. Assisted living averages about $60,000 per year. Home health aides cost between $30 and $40 an hour, and a private nursing home room can top $125,000 per year. And the probability is higher than most people think. In married couples over 65, one spouse is likely to need some form of long-term care in the future. 20% of people will need long-term care for 5 years or more. The average, though, is about a 2 to 3 year event, and women on average require more long-term care than men due to their longevity. And these aren't scare tactics, they're planning realities. The mistake most retirees make isn't understanding the cost. It's failing to plan for how they're going to cover it. Long-term care is fundamentally a financing problem, and insurance is just one way to solve it. So your first option for covering a long-term care event is traditional long-term care insurance. So let's go over the pros and cons. Traditional long-term care insurance is designed like homeowners or auto policies. You pay premiums, and if you need the coverage, the policy pays you the benefits. But over the past decade, traditional long-term care insurance has become less prevalent. Why? Insurers often underestimated claims and raised premiums dramatically. Many companies have left the market entirely, and premiums aren't guaranteed, and they often rise. Still, traditional long-term care policies do have advantages. They have the lowest upfront cost compared to hybrid policies. They have the highest leverage, which means the benefit you receive can far exceed premiums paid. And they have customizable coverage. There's elimination periods, daily benefit amounts, and inflation riders that you can manipulate in order to make this more cost effective. But there are serious drawbacks. Premium increases are common and often unpredictable. It's a use it or lose it type of policy. If you never need care, the premiums are gone. While there are some that have a life insurance payout component to them, it's often not much more compared to the initial premium that you paid in. It's also harder to qualify for after the age of 65 or with health conditions. So traditional long-term care, though, it does work best for some people. People in their 50s or 60s who have stable health, who want high coverage at a relatively low upfront cost, and who can handle potential future premium hikes. But if you hate the idea of rising costs or wasted premiums, the next option might suit you better. Let's talk about the second option, and that's a hybrid long-term care insurance and life insurance policy. And hybrid policies have exploded in popularity because they address the biggest fear most retirees have. What if I pay for long-term care insurance and I never use it? Hybrid policies solve this by combining the life insurance component with the long-term care benefits. If you need long-term care, the policy pays to cover that care while you need it. If you don't, your beneficiaries are going to receive a death benefit tax-free. If you change your mind, many policies allow a partial or full withdrawal of your premium. And there's also some advantages of the hybrid long-term care policy. Premiums are guaranteed and even flexible, unlike the traditional long-term care policies. You always receive value, either through the long-term care benefits itself or your beneficiaries through the death benefit. There's easier underwriting than just the long-term care insurance alone. It can be funded with a bigger lump sum or level premiums. But there are some drawbacks that you want to be aware of. There's higher upfront costs, often $75,000 to $150,000 for strong coverage. There's lower total leverage than traditional long-term care, which means your benefit per dollar is a little bit less. It ties up capital that could otherwise be invested, And if market performance is poor, your policy could actually lapse or require you to make extra contributions to make sure you don't lapse and create a taxable event. Hybrid policies typically work best for people in these types of situations. And that's people with assets who want guaranteed coverage without rising premiums, those who dislike use it or lose it type of insurance. So the auto insurance comparison wouldn't happen here with the hybrid policy because you're either going to get the death benefit or the long-term care payout. Or for those of you who are focused on estate planning and protecting your heirs, if you never utilize this coverage, the death benefit that your heirs receive can help pay for some of your estate taxes if you do find yourself in a taxable estate. So if traditional long-term care is the pure insurance play, hybrid long-term care is the peace of mind and estate planning play. Your third option for funding long-term care is self-funding. That's when a bigger portfolio is your long-term care plan. Many high net worth households choose not to buy long-term care insurance at all. Instead, they plan to pay for care directly out of their savings. This approach works if you're financially prepared for it, and that's the key. Self-funding is not the default. It must be an intentional, modeled strategy. Here's how to evaluate whether self-funding makes sense. Self-funding works well if you have a larger portfolio, somewhere between $3 to $5 million at minimum. Long-term care expenses won't derail your spouse's long-term financial security if you were to incur an event. You maintain strong liquidity. Not all your assets are tied up in illiquid holdings, and you understand and accept the risk of unpredictable expenses. But here's where self-funding fails. Long-term care needs come earlier or last longer than expected. Market downturns overlap years with high long-term care costs. The healthier spouse is left financially vulnerable, or taxes and required minimum distributions increase pressure on withdrawals. The biggest mistake self-funders make is assuming I have enough without running long horizon simulations that include inflation at 3 to 4% for long-term care costs, which typically rise faster than core inflation, market volatility during withdrawal years, the survivor's expenses and income after one spouse passes, and the tax impacts of large withdrawals. A $4 million portfolio can support self-funding or collapse under it, depending entirely on how it's structured. Regardless of whether you self-fund or supplement with insurance, the smartest approach to take is to designate a portion of your assets as a long-term care reserve bucket. This isn't a separate account, it's a mental and financial framework that segments your assets. There's a core retirement spending bucket, which is your lifestyle income. There's your growth bucket, which are equities and longer-term investments. And there's your long-term care reserve bucket, which is assets allocated specifically for potential care, whether it's self-funded or your insurance benefit. This reserve bucket might include things like a portion of your taxable brokerage account earmarked for care, a portion of your bond ladder or treasury income, cash value from a hybrid life and long-term care policy, or home equity for those of you who are comfortable using it. Reserve buckets create clarity. They separate lifestyle risk from healthcare risk. They help couples plan for survivor income, and they reduce panic withdrawals during market downturns. Think of it as giving long-term care its own lane so it doesn't disrupt every other part of your financial plan. Before we jump into some mistakes to avoid, please be sure to throw this video a like. We help clients every day with their full financial plan through these videos. Long-term care is just one piece of that puzzle. So to catch other videos we have coming out on other planning topics, don't forget to subscribe. That is the best way to stay up to date on your financial plan. Let's jump back into the video. The first mistake that I see is people wait too long. Premiums rise with age, and health underwriting becomes harder every year. Many policies are simply unavailable or unaffordable after the age of 70. Second is not planning for inflation. Long-term care inflation often exceeds core inflation. A $5,000 per month benefit today may be inadequate 10 or 20 years from now. Next is people rely on one-size-fits-all policies. Your care plan should reflect your assets, not your neighbors. Wealthier retirees often buy partial long-term care coverage, not full. Fourth is ignoring the healthy spouse's risk. If one spouse needs care, the other may face reduced assets plus longevity risk. Planning must address both lives. Finally, if you're using home equity as the entire plan, your home is an asset, but relying on it exclusively creates liquidity and timing challenges. So which approach is best? Well, traditional long-term care insurance is typically best for people who have high coverage needs, lower upfront cost preferences, willingness to accept premium increases, and people in their 50s and 60s with good health. Hybrid policies typically work best for those who want flexible premiums, those who want death benefit if long-term care is never needed, households with sufficient liquidity, and people who value simplicity and predictability. And self-funding is typically best for people with at least $3 to $5 million portfolios, those comfortable absorbing financial uncertainty, those who prefer to avoid underwriting, and households where long-term care spending won't threaten survivor security. There is no universally right answer, only the strategy that aligns with your values, your assets, and your willingness to absorb risk. Let's go over two different clients now. We have client A, who's a married couple at age 65. They've done a really good job saving, and all of their money is in pre-tax IRAs. They have $3 million. But client A has not done any planning and have no long-term care plan other than self-insuring. On the other hand, we have couple B, and they've saved about $2 million. And they have done some planning, and their $2 million is in half in Roth and half in traditional. They've also purchased a long-term care insurance policy via hybrid life insurance policy that provides up to $100,000 in coverage for up to 4 years. And if they never use it, that ends up being a tax-free death benefit to their kids. One of the spouses in client A now has a long-term care event. On top of the $80,000 they pull from their portfolio every year to supplement Social Security, they now need to pull $120,000 for a long-term care event. This pushes them into the 22% tax bracket. So after they account for taxes and distributions, they take out roughly $300,000 a year. This goes on for 3 years until the spouse passes away. And unfortunately for them, the market has had a few bad years and was down 5% annually compounded over that same time. Their ending portfolio in this instance, after the 3 years, is roughly $1.7 million, which means they have to withdraw roughly 5% of their portfolio to keep up with expenses at that point, which is a bit higher than what we would recommend, and that's before tax. It also doesn't take into consideration the fact that they're going to lose that spouse's Social Security when they pass away and only retain the higher benefit of the surviving spouse or the spouse who passed. So their outflows from that account could be higher than 6 or 7% by the time we get them back to the point where they were before. Client B, on the other hand, had the same exact scenario, except they only have to pull $20,000 annually from their portfolio for long-term care and $80,000 for expenses. They have the option to do it from Roth or traditional, but for argument's sake, let's say they pull from traditional, which is probably optimal. They may want to pull a bit from Roth to just manage their tax brackets effectively, but just for the sake of the example, we're going to overly simplify it. So they pull about $120,000 annually after tax. They're going to be in the 12% tax bracket after they account for Social Security and deductions. So they'll have to distribute from their portfolio roughly $112,000 annually. In that same down market scenario, they would be left with about $540,000 in traditional accounts and $860,000 in Roth, so roughly $1.4 million total. So with what started as $1 million difference between the couples has been reduced to a roughly $300,000 difference. And that $300,000 difference will likely be more than offset by the tax savings of couple B's Roth allocation. In this instance, the long-term care policy was worth nearly $700,000 to couple B versus couple A in the same exact scenario. That's really powerful stuff. So what's the bottom line here? Long-term care planning isn't about predicting the future. It's about protecting your future self or your spouse from uncertainty. Insurance is one tool. A well-structured portfolio is another. The smartest plans often combine both through reserve buckets, partial insurance, and tax-efficient withdrawals. You don't choose between insurance or no insurance. You choose how to fund the risk and how to protect the people you love. If you want help modeling traditional long-term care, hybrid long-term care, or self-funding strategies and seeing how each impacts your long-term retirement plan, that's exactly what my team does here at NavWealth Partners. Thank you so much for watching, and as always, make smart money decisions.